The Fed now expecting more rate cuts next year. What is the outlook for housing stocks in that environment? Joining us this morning is Oppenheimer's Tyler Batory. Tyler, it's good to have you. I mean, an important 24 hours we just had. What does this new rate environment do to some of these builders' margins and orders?
It's definitely a tailwind, certainly. And look, you look at the playbook for next year, which we think is definitely going to be turbocharged by what happened yesterday. I think the playbook and the outlook for next year looks pretty similar to this year, actually, for the industry. Still limited existing inventory out there. We don't really see that changing. So there's a market share shift underway where new homes or a lot of locations are the only game in town. The public builders, they have size, scale, access to capital that allows them to grow their inventory, buy down interest rates. That's attractive for the end user and for buyers. So there's really a market share shift going on where the demand is being funneled to new homes. It's being funneled to home builders. And for the stocks, we think it's a group that's really grown up. These management teams, the public builders collectively, they're very focused on returns. They've really adjusted how they think about deploying capital. So you roll that all up in the blender. We think there are some fundamental tailwinds here. And I think an outlook that's really quite positive for the industry and for the sector overall.
Is there an argument that if rates come down enough that it unleashes a supply of existing homes and the new builders do face more competition?
Yeah, it's kind of odd to think lower interest rates might not be a good thing for home builders, but certainly this tailwind in terms of limited existing inventory. The reason why there's not much existing inventory out there is because 40% of those homeowners with a mortgage have a rate below 4%. So if you have a mortgage rate that's at 3%, 3.5%, trading that for a 7% mortgage doesn't really make a whole lot of financial sense. Obviously, if rates start to tick down, that math starts to change a little bit more. So it is possible you could get some incremental inventory coming onto the market next year. But our perspective is lower rates would be a good thing for demand that would offset any incremental supply that might come. And then for the home builders, if rates are lower, likely means they don't have to offer as much in terms of incentives. That's a tailwind for their gross margin too. So from our perspective, with rates potentially moving lower next year, mortgage rates moving lower as well, we think that's a tailwind still for the industry.
I mean, it was a funny environment for home builders because the stocks actually did fine as inventories were low and prices remained high. Tyler, is there worry that prices could go even higher now if this unleashes a lot of activity in the mortgage market, which would make the Fed worried again?
Yeah, it's definitely a potential risk, and this supply-demand imbalance that's in the market, I think, does give builders pricing power. You look at what homes are going to be running through their P&L this year, you're going to see the impact from some of the higher incentives activity level earlier in 2023. But you look towards next year, especially the back half of the year, if interest rates cooperate and even stay the same as where they are right now, there's going to be demand, and the builders are trying to meet that demand with more supply. But again, the key to this whole story is that there's not a whole lot of existing inventory out there on the market. There's going to be more demand than there is supply. Simple economics in that sort of a situation should give the builders pricing power and the ability to raise prices.